do you think it's possible the Fed may raise rates to help bank net interest margins and then turn around and go for QE to support the stock market?
Oh, you want the Fed to do what to net interest margins?
If they, maybe they'll raise rates to try to help net interest margins, but I think that's something you can maybe address that assumption that that's going to help net interest margins.
So I don't have a lot of room here. We're gonna have to, maybe this goes like this. Net interest margin. So net interest margin is NIM, the 10-year yield minus the 2-year yield. This morning that equals 79 basis points. Okay? 10-year minus the 2-year yield equals 79 basis points. That, if the Federal Reserve raises rates, the 2-year is going to go up and the 10-year is going to go down. This is going to go even flatter, down. Got it? People say, oh, no. Everything's supposed to go up. When they raise the 2-year, the 10-year should go up too because the Federal Reserve thinks that the economy is bullish. So the economy should go bullish. Shouldn't it? For God's sakes, think for yourself. If the Federal Reserve raises interest rates, not only does the 2-year go up, but the US dollar goes up, oil goes down.
Yeah, I mean, what happened when they did it in December?
Exactly. We call that deflation's dominoes. Deflation's dominoes, okay? When the Fed gets tight into a slowdown, again, increasing the value of dollars, things that are priced in dollars, particularly debts and commodities, go down in price. Okay, that's called the deflation of the reflation. You can't have reflation on down dollar and not get deflation of the deflation of the reflation if the dollar goes up. So if the Federal Reserve were to tighten, which is, by the way, happening across the curve at the low end. If you separate, you shouldn't say across the curve at the low end. I don't even know if that's. I don't care if Wall Street doesn't say it that way. If you take all the low end of the curve, you take 3-month, 3-month Treasuries, 6-month Treasuries, all the way up to 2-year Treasuries. 6-month Treasuries, for example, this morning are up another 4 basis points to 0.45%. They're up about the 6-month Treasury rate is up 25 basis points. So of the 45 basis points that it's at, it's up 25 basis points versus where it was last year. So the short end keeps climbing because the Fed keeps saying, I'm going to get tighter, going to get tighter. I can do tighter, I could go tighter, 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 tighter. Oh, we got this regulation thing? Damn it, that's going to tighten it anyway. LIBOR is going up. So they are getting tighter and have been getting tighter into the slowdown. Net interest margins come down, bank profits have come down, bank stocks have come down, bank multiples have come down. The whole thing makes absolute sense. There's no reason why somebody shouldn't be able to articulate this to you. If the Federal Reserve raises interest rates, the short end of the curve goes up, again, net interest margins come down, bank stocks go down, dollar goes up, oil goes down. That's what I think happens.